The raise had already been processed by payroll when he realized it would not change anything. It showed up in the mid October paycheck, a modest adjustment tied to the annual review cycle, the kind that signals stability rather than advancement. After federal withholding, state taxes, Medicare, Social Security, and the increased retirement contribution he had set years earlier, the net increase was smaller than he expected. By the time the deposit cleared, it was absorbed into a checking account that had grown accustomed to handling fixed obligations without drama. At 47, his income was higher than it had ever been. It had taken 2 decades inside the same industry to reach this level, moving laterally once, promoted twice, never unemployed for more than a few weeks. The salary number looked substantial when compared to his early 30s. On paper, it reflected progress. In practice, it landed in a financial structure that had already solidified. The mortgage had been refinanced during a low rate cycle several years earlier. The payment was predictable and no longer a subject of anxiety. Property taxes, however, had climbed gradually as assessed values rose in the county. Homeowners insurance adjusted upward after a series of severe storms in the region. Utilities fluctuated with season and rate revisions approved by the state commission. None of it was dramatic. Each increase was incremental, rational, and documented in formal letters that arrived without urgency. Health insurance premiums were deducted before he ever saw his gross pay. Over time, plan changes shifted more cost sharing onto employees. The deductible was higher than it had been a decade earlier. Prescription copays ticked up. The family adjusted without discussion. They scheduled procedures strategically, timed dental visits around annual maximums, and absorbed the rest. Retirement contributions had increased steadily since his late 30s. What began as a cautious 6% to capture an employer match eventually became 15%, partly from discipline, partly because it felt safer to automate it. The brokerage statement each quarter showed growth, volatility, recovery, and growth again. The balance was larger than it had ever been. It still did not feel finished. His spouse worked as well, though her earnings had flattened earlier. She had shifted to part time hours when their second child entered middle school, a decision that reduced stress at home and slowed her own career trajectory. Her income covered groceries and a portion of extracurricular costs. It once felt temporary. It had become permanent without announcement. Their older child was approaching college age. Tuition estimates arrived in glossy mailers and sober financial aid portals. Even after years of contributing to a 529 plan, the projected 4-year cost exceeded what they had saved. The shortfall was not catastrophic. It was structural. At work, younger colleagues were hired at salaries not far below his own. The company had adjusted compensation bands to attract talent in a competitive labor market. Annual increases for existing staff were narrower. The difference between entry-level and mid-career pay compressed quietly. He noticed it when onboarding new team members, signing off on compensation paperwork that required executive approval, for amounts he once would have considered ambitious. His role had expanded in responsibility, but not in title. The organization flattened this hierarchy during a restructuring, eliminating certain managerial layers. The official explanation emphasized efficiency and agility. In practice, it meant more direct reports and broader accountability without a corresponding leap in compensation. The annual bonus formula was revised to tie payouts more tightly to corporate performance metrics. Some years it paid out fully. Other years it did not. In his early 40s, he believed the most significant income growth was still ahead. There were senior positions above him, each carrying a meaningful salary differential. Over time, those roles were consolidated or filled by external hires with specialized credentials. Advancement narrowed to a small aperture. He remained valuable, reliable, and visible. The pay scale around him stabilized. The family's fixed expenses had matured alongside his career. The car loans were replaced every several years, each new vehicle slightly more expensive than the last, reflecting safety features, inflation, and longer loan terms that kept monthly payments manageable. Auto insurance premiums rose as repair costs increased industry wide. Streaming subscriptions accumulated one at a time, each justified, none individually significant. Property maintenance no longer waited for surplus cash. The roof replacement, the HVAC system upgrade, the plumbing repair in the basement. Each was financed either through savings or a short term home equity line that was repaid methodically. The house was in better condition than when they purchased it. It required ongoing capital. He did not feel financially strained. Bills were paid on time. Credit card balances were cleared monthly. There were no collection notices, no urgent calls from lenders. The emergency fund covered several months of expenses. By traditional measures, the household was stable. What shifted was not their solvency, but their trajectory. In his 30s, each raise altered the household margin. There was room to redirect funds toward investments, accelerate principal payments, or increase discretionary spending without recalculating everything else. Growth felt linear. Effort translated into visible improvement. In his late 40s, raises were incremental and largely pre allocated. Healthcare costs, insurance premiums, tuition savings, and retirement contributions absorbed them automatically. The checking account did not swell. The brokerage account grew gradually, but its growth was driven as much by market performance as by new contributions. The margin narrowed not because income declined, but because obligations matured. He began to recognize that his earning curve had flattened before he had consciously acknowledged it. The company's compensation model was designed for retention rather than acceleration. Mid career professionals were rewarded with stability, not dramatic advancement. The salary band had a ceiling that was not formally stated, but was evident in annual merit increase percentages. Taxation amplified the effect. Each additional dollar earned at his bracket was subject to higher marginal rates. The net benefit of incremental raises diminished. Payroll deductions for retirement and health benefits compounded the compression. The gross figure on his offer letter years earlier had carried symbolic weight. The net figure now governed reality. He reviewed past W-2 forms one evening, lining them up chronologically. The early years showed steep percentage increases. The last 5 forms were nearly horizontal in comparison. The numbers rose, but the slope had softened. Inflation adjusted for purchasing power, the real increase was modest. Their lifestyle had not expanded recklessly. They did not move into a significantly larger home. Vacations were domestic more often than international. Dining out was occasional. Yet, the baseline cost of maintaining their life had grown in line with national averages. Groceries cost more than they had 5 years earlier. Home repairs were quoted at higher labor rates. College savings targets rose annually. His parents, now retired, occasionally mentioned the difference between defined benefit pensions and the defined contribution plans that dominated his generation. Their income in retirement was predictable, supplemented by Social Security. His retirement projections depended on market returns, contribution rates, and withdrawal assumptions. The responsibility rested on accumulated assets rather than employer guarantees. The realization did not arrive during a crisis. It settled gradually over several quarters of similar pay stubs. and similar expense statements. The pattern became visible only when viewed longitudinally. He was unlikely to double his income from this point forward. The market value of his skill set was established. Lateral moves might yield marginal increases, but they would also carry risk, probationary periods, and the possibility of cultural mismatch. The opportunity cost of disruption was no longer abstract. Colleagues his age spoke less about promotions and more about endurance. Discussions in conference rooms turned to vesting schedules, healthcare coverage continuity, and the timing of social security eligibility. Ambition recalibrated into preservation. At home, the children's needs evolved. One required a car to commute to a part time job. Insurance for a teenage driver was higher than he had anticipated. The other discussed out of state universities whose tuition figures were precise and immovable. Financial aid calculators provided estimates that assumed stable parental income. He recalculated the household budget one Sunday afternoon, not to cut spending, but to observe its composition. Fixed expenses accounted for a larger percentage than they had a decade earlier. Discretionary categories were narrower slices. The capacity to meaningfully alter outcomes through minor adjustments was limited. His net worth had increased over time. Home equity appreciated alongside market gains in retirement accounts. Yet liquidity remained measured. Much of the wealth was locked in tax-advantaged accounts or tied to real estate. Accessible cash beyond the emergency fund was not expensive. The plateau was not a decline, it was a leveling. He still performed well at work. Performance reviews described him as dependable, knowledgeable, a cultural anchor. There was satisfaction in competence. There was less novelty in compensation. He noticed that conversations about money shifted tone. In his 30s, peers compared raises and job offers. In his 40s, they compared 529 balances and healthcare premiums. The metric of progress changed from income acceleration to cost containment. Inflation reports on the news felt more personal than before. A percentage point increase in consumer prices translated into tangible adjustments at the grocery store and gas pump. Annual cost of living adjustments from the company rarely matched headline inflation precisely. The difference accumulated quietly. He did not regret his career choices. The industry had provided stability, benefits, and predictable hours. It allowed him to attend school events and maintain routines. The trade off was not obvious at the beginning. It became visible only after years of compounding decisions. When the latest raise appeared in his payroll portal, he compared it to projected college expenses, healthcare estimates, and retirement targets. The arithmetic was straightforward. The incremental increase would maintain their current path. It would not accelerate it. The household budget, once flexible, now behaved like infrastructure. It supported the life they had built. It resisted rapid modification. He sometimes thought about earlier moments when risk felt tolerable. Starting a business, relocating for a higher paying role, pursuing additional credentials. Each option had been considered and deferred for rational reasons: childcare, mortgage stability, geographic preference, employer benefits. The accumulation of rational decisions formed a structure that was sturdy and slow moving. There was no external signal announcing that his peak earning years had likely arrived. No letter from HR, no formal plateau notification. The evidence existed in incremental percentages, market salary surveys, and internal compensation bands. He continued contributing to retirement accounts, continued paying down the mortgage on schedule, continued funding college savings. The system functioned. The realization did not demand action. It altered perception. Income growth in midlife, he understood, often transitions from expansion to maintenance. The household adjusts not to rising aspiration, but to sustained obligation. Stability replaces acceleration as the defining feature. On Monday morning, he logged into work, reviewed his calendar, and joined a meeting about next quarter's objectives. His salary would deposit again in 2 weeks, slightly higher than the last cycle, absorbed by a budget that no longer expected transformation.